how do you take crypto signals for maximum profit? Now, when we talk about signals could be developed by you. It could be something that you created yourself as a result of your technical and fundamental analysis, including your sentiment analysis. When we get there, you will get to understand what all these things means. So alternatively, you can take that which has been created by someone else, usually experts, people who do the groundwork for you and just give you their trade signals, okay, so that you can take the exact same trade that they are also trading themselves. So if you don't trust them, please don't take their signals, because you're going to lose money taking other people's signal if those people don't know what they are doing. So let's continue. Now, first, let us define crypto trading signal. Crypto trading signal are trading ideas or trade suggestions to buy or sell a particular coin at a certain price and time. These crypto trade signals are generally either manually by a professional trader or by trading algorithms and bots that send the trade signals automatically. Usually, the trade signals have also attached a take profit and a protective stop loss. Basically, your back is covered from all sides. Sorry, let me just close my Telegram and my WhatsApp. So okay. So that's it about definition. It's just about a trading idea or suggestions to either buy or sell, okay, a particular coin based on some fundamentals or technical analysis or both done by that particular trader, usually by a professional trader. So if you are the one who is populating these signals, then you are the professional. But if you are not the one, you're getting it from someone else, okay. Usually the trade signals have also, there are features of signals. The signal must have a take profit, like where it will get to and you take profit. Remember, in this space, if you don't take profit, you wouldn't say that you have traded, because it's possible that you just be in a coin and it will go up and it will still come down and take all the profit that it has yielded to you, okay. And a good trading signal must have stop loss also. Stop loss is what if it goes against you, okay. What if it goes against you? What is the amount of loss you are willing to take on that trade? If you've determined that, you place it so that once it gets there, whether you are sleeping or you are at work or you are on the road, the platform you are using will just close that trade and minimize the loss for you, okay. So basically, your back is covered from all sides. That is if you're taking this signal from someone else. Let me pause this and okay, let's continue. That is it about the definition. Let's go over to the next slide. So this is an example of a cryptocurrency trade signal. Now in this image, you can see that it's either a buy or sell. The buy is the green, the sell is the red, okay. So and that is how it is represented in exchanges, okay, depending on whether it is a spot, you're trading under spot or under futures. If it's under futures, you can see things like long under this buy. You can see under sell, you see short, okay. So another name for buy is long, that is if you are using leverage. Another name for sell is short if you are using leverage. Now aside that, another feature is the take profit. So for example, let's say buy or sell Bitcoin at the rate of $7,450, okay, and I say this is the rate that this is at the price you're supposed to buy or sell, depending on on the signal the person gives you. Now they say take profit at 8.2. Taking profit at 8.2 means that you're buying actually. So this is a buy order. They say buy Bitcoin at 7,450. Take profit at 8,200. It means you're buying at this price. So assuming, let's say Bitcoin is at 7,600, you have to wait for it to get to 7,450 for maximum profit. But if you are willing to allow it to go down and still come up and give that profit, the take profit, which is at 8.2, that's still okay. It all depends. But if you are sure that it's going to get to 7,450, so why entering it at 7.6? Just wait for it to hit that place. You enter and the market will move depending on the analysis. Okay, so let's say you were able to buy it at that 7,450 and you take profit at 8,200. Sorry, let me sort out. Okay, so let's say you bought Bitcoin at 7,450 and you take profit at 8,200. That's good profit. Now the stop loss, that is where you can get to and you take your loss, so that your account will not be liquidated, especially if you're trading on with on margin, like with leverage. So your stop loss is at 7,000. Now let's do a little mathematics to calculate how this will affect your account. So I'm going to use a tool called percentage calculator. Let's see how this will affect your account. So you bought Bitcoin at 7,450. Okay, so what is the percentage of what is, oh no, let's use the last one, 7,450 to, where is your take profit? Your take profit is 8,200. 8,200. How many percent did you make? You've just made 10%. 10% on this trade, just for BTC to move from 7,450 to 8,200. You've made 10% for those that are trading on spot. But me and you know that this cannot be the case if you're trading with leverage. On leverage, it is something else. It is something else, because this 10% depends on how much you are using, how much you borrow. So it's more like 10% of how much you borrowed. So let's say you borrow, on that leverage, you're trading with 10,000 Bitcoin, $10,000 worth of Bitcoin. That 10% of $10,000, that's what you will make. Okay, so you now calculate the percentage of that amount, divided by the total amount that you enter that trade with. That's the original amount, aside the one that you borrowed. That's what will tell you how many percentage you made using leverage. Okay, but on a normal, you just bought and you kept and you got 82, you've just made yourself 10% of that. So if it is spot and you're using big money, remember, it all depends on your capital. If you're using big money and 10%, you made 10%. For example, you're using 1 million naira. 10% of 1 million naira is 100,000 naira on this particular trade. So let's see how much you're willing to lose if this thing goes against you. We'll now place it the other way around. Your stop loss is at 7,000, and you actually enter the trade at 7,450. You calculate to see how much you've lost. 6.4%. Okay, 6.4% is the amount you are willing to lose. When we get to risk to reward, you will get to understand what this is all about and how you can, calculate your portfolio in such a way that you wouldn't be losing a whole lot of money on this. Okay, so that is it about this. Let's continue. Now on the targets, like we said here, the target here, this is the take profit. It's also called target. You can have target 1, 2, 3, 4, 5, 6, depending, as many as possible targets as you want. You are going to also see how you're going to be taking profit, because most times it's not good to just say take profit is at a point. No, because it's possible the market might not get to that point. It's possible the market might not get to that point. So that's why you break it down, break the take profit down into, for some people who use the Fibonacci retracement tool, they use the points of support and resistance as their take profit. Okay, anywhere that they see resistance, they put it as take profit. Where the next resistance comes, that is another take profit. Where the next resistance comes, that is another take profit. Just like that, you get to that your final destination, which is take profit 6 or take profit 4 or take profit 3, depending on how you structure your own take profit. We'll get to know more about this. Okay, so these are known facts that you should know about. Anyone who has an educational foundation in trading understands that no one, including the best of the best, can win every trade. So it's a game of numbers and risk management. So someone with a win ratio of over 50% should win in the long run if they are consistent and disciplined in their use of this factor. So these are the things you need to know about. Whether you are taking someone else's trade or you are taking your own trade, you need to be very, 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 very extremely careful about this thing. You need to, put this into your trade setup. So the first one is probabilistic setups. That's when you're taking a trade, make sure that there is high probability that it will go in your favor. Make sure that there is high probability that it will go in your favor. Now, how do you know this? It is through the use of your fundamental analysis. Fundamental analysis is just about news. You need to check what news is actually out there. What is actually happening in the economy? Is there anything out there that can affect the market? Do you think any news can come up anytime? Maybe a lawsuit or just anything. You preempt, and then when the news now hits, remember what you're actually trading is the rumor, because the rumor must come out most times before the news. So when the news now hits, it will now take effect in the market, or most times it is the rumor that now takes effect, and the news, you must have been losing during the news or something like that. Okay, so the second one is properly place stop losses. Stop loss is very, very important, extremely important. You do not leave your trades to run, except you are George Soros, or you are what's this other Warren Buffett. All these people that have serious money, that when they place trade like this, their liquidation point might be maybe if BTC get to $50,000. You and I know that that's a long time to come before that can happen, or even if it comes, it will take a whole lot of things before that would happen. So those kind of people can afford to leave their trades running without stop loss. But some of them, even with their big money, are not stupid to run on trades without stop loss. But we've seen big names like Joe. There's one Joe who is a whale who, most times he allows trades to run, and then he just keep adding money until the market plays out to his own tune. But for you, whether you have big money or you don't, please make use of your stop loss. Make sure you calculate your stop loss and always put it. The good thing about it is, most times, for example, let me give you an example. Early this year, when this COVID-19 stuff, it started last year, but this year the economy, it now spread through the world, and then we had in a single day, I think we had like 70% loss on Bitcoin. I think within 2 days, it happened within 2 days, 50% in a particular day. That was something that has been very, very, very long before we experienced, that kind of thing. And I'm not sure, I think that should be the highest. I think, in a single day, we lost that kind of amount in Bitcoin. So, how did it happen? The whole market was just crashing, the stock market, crude oil, everything was just crashing, and Bitcoin was just enduring those things. And then on the second day, the thing just lost it, and everywhere just started crashing. So setups could not have predicted that, except someone who understood that yes, this COVID-19 stuff was bound to affect the crypto space. Some of us knew, but it delayed actually before it played out. And what saved us? Because we had stop loss. So if you don't have stop loss, a lot of people lost money in the stock market, in Bitcoin and all that. Even though the market has recovered now anyway, or it has recovered now actually from that loss. But it would have saved you a whole lot of stress of waiting till now before the market, before your investment will just come up to where it used to be. So some people who you had stop loss, they just took small loss and now understood the movement of the market. They recalculated and they made made profit that will cover that loss within a day. Yes, it happens like that. So you need to have stop loss in all your trade. And the third one is favorable risk to reward ratio. When we talk about risk to reward ratio, we are talking about how much you make or lose when you win or lose a trade. Okay, with a risk to reward ratio of, let's say, 1:7, it suggests that an investor is willing to take risk of $1 for the prospect of earning $7. Alternatively, a risk reward ratio of $1 to 1:3 signals that an investor should expect to invest $1 for the prospect of earning $3 on his investment. So you calculate that according to how much you're putting in that trade. Now let me give you an example. If someone is to go and rob a bank, would you take the risk of robbing a bank, dislodging all those securities and breaking that iron gate and then entering there to just go and steal 500,000 naira? I don't think anybody will be stupid to take that. So it means that the risk to reward, the risk, taking more risk and getting less reward for that risk, and that is something you wouldn't want to do. Your risk should always be low and your reward should always be higher than the risk. That is it about risks to reward. You cannot be having 7:2. 7:2 means that you are taking a risk of 7% and you are getting a reward of 1%. You're taking a risk of $7, and if the trade works in your favor, you are going to get just $1, or if it's 7:2, you're just getting $2 out of that trade. So you must make sure, try at all possible means to make sure that the risk is lower than the reward. That's a safe trade. Not like it's 100% safe, but it's the risk is lower, and that's a good thing. Now the next thing, the fourth point you need to know here is good position sizing. For example, if an investor has a $25,000 account and decides to set their maximum account risk at 2%, they cannot risk more than $500 per trade. So 2% times $25,000. Even if the investor loses 10 consecutive trades in a row, they have only lost 20% of their investment capital. That is like 2 times 20. That's 20% of their investment capital. Now, why is this good? Some people will have $25,000 and they will enter one trade. Maybe you have a signal, you created it yourself from your analysis, or someone gave you. You just go all in and enter one trade without 25,000. What if something happens? You will lose your whole capital. But if you have a good position sizing, usually I advise newbies to use not more than 1% of your capital. Another thing to consider is that you must have a favorable risk to reward ratio. If your risk to reward ratio is good, then you can increase your position sizing, because you're seeing that the risk is very low, so you can increase maybe to 2% or 3% of your capital. So do not risk all your capital in one trade. Use between 1 to 3% on each trade. Okay, so when you lose, you are just losing a certain percentage of your total capital. You understand me now? So with this, I tell you the truth, you will never lose. People who lose are people who are going all in. They are the people who lose. Because let me give you an example. If you get your position sizing right, you have, let's say, $10,000, okay, in your trading account, and you're just taking 1% risk. You now check 1% of $10,000. That's like $100, but that's small anyway. Or let's say you're taking 5% of your $10,000. 5% should be around $500 per trade. $500 per trade. And your risk to reward ratio is good. Let's say 1:7, 1:5, 1:6, 1:4. Okay, if you make, let's say, 30% of that on that trade, on each trade you take with that $500, that is good. In a day, maybe you take like 3 trades or 4 trades, or maybe in a week you're able to win, let's say, 10 trades. Or you're able to take 10 trades, you lost 2 or 3, because you can never win all of them. Okay, so if you win, let's say, 7 out of it, your money will just keep increasing. Your portfolio will keep increasing. It will keep increasing because you're not going all in. Okay, trade 1 might win, trade 2 will lose, trade 3 win, trade 4 win, trade 5 win, trade 6 win, just like that. That's small $50, $100, $200, $500, depending on the total sum you have in your account and your position sizing. It will keep adding on your account, and that $25,000 account will move to $26,000, $27,000. Don't rush it. Accumulate it gradually. accumulate it gradually, and when you lose a trade, it will not even be as if you lost anything, because your position sizing is right. You need to get these facts. You need to. If you don't get them, I tell you the truth, you're going to make a whole lot of mistake in this industry. Now take every trade with the right position size, and each with equal position sizes. By equal position sizes, it means that you cannot go and take trade 1 with $500, trade 2 $1,000, trade 3 $2,000. No, you have to be disciplined. Determine what your ratio is. How many percent are you willing to lose in a trade? Let's say you lose everything, and your position sizing is just 2%. It means that if you lose the whole of that trade, you've just lost just 2% of your total capital. You understand that? So don't take a position risking more than 1% of your capital. I know this might seem very hard for people with small capital, but I tell you the truth, you need to learn that discipline with small capital, so that when big capital hits your account, you will still do the same thing. So this means if you have $10,000 set aside for trading, okay, in the group, maybe in a group that you are taking signal from, or in your own account, and you're populating that signal for yourself, and you enter a position with, let's say, $1,000, but your stop loss is at 10%, meaning you can only lose $100 maximum on the trade. And meanwhile, $1,000 of $10,000 is actually 10%, right? That's 10%, it's not 1%. Okay, so meaning you're going to go, let's say that's the amount you're risking on this trade. Okay, that's 1/10, right? Okay, so meaning that if you use $1,000 here, you're going to lose just $100 if you lose 10% in that trade. That's if you had good stop loss. Okay, now then, and remember, your stop loss should never be above 10%, or some people, big traders, go for like 15%. Okay, I have not seen any reasonable trader go above 15%. Yes, because it means that your setup has been invalidated. You need to reanalyze and see if that your trade will still happen. If it will still happen, you reanalyze and look for the next support and enter back, okay, in the same position. So you're only risking 1% of the trade. Okay, this means you can only be in 10 trades at a time, unless you've already taken profit on a couple of trades, which is likely. Then you have fresh powders. By fresh powders, we mean you have more capital to trade with. So the next thing we need to talk about, very very important, is stop loss. Now you need to set your stop loss immediately your trade picks up. That is why it is not good for you to just enter a trade and go and sleep. Like you place your trade and the trade has not clicked, you just go and sleep. It's possible that when the trade picks, it will get against you. You wake up in the morning, you are in serious loss. Okay, so you make sure that you watch your trade, make sure that you enter the trade, and when you enter, you set your stop loss and you go and rest. I think you can even be able to set stop loss immediately. I think so, but I've not done that. I always set my stop loss when my trade has picked. So whenever you enter a trade, do not ever neglect to set your stop loss immediately. Okay, so take profit, very very important. Remember, we've talked about it earlier, but let me just break it down for you now. So take profit gradually and move your stop loss as you take the profit. So let's say, for example, let me open a notepad. We say buy Bitcoin, buy BTC at 7,000. That's $7,000. Let me put the dollar sign so you will understand that. Okay, TP1, let's say 7,200. TP2, 7,300. TP3, 7,400. Okay, let's give final TP. Let's say TP4. TP4. Place TP4 at 7,400. No, 7,500. So this is the same thing as saying buy BTC at 7,000, take profit at 7,500. So this is my final destination. Okay, but it's always good to break it down into points, resistance points, resistance points, resistance points, so that in case it's possible that you do not get to TP4, there are people that have placed trades and they say take profit at 7,500, for example, and then the trade down gets to 7,490 or even 499, and the market will go down. That market, they did not take profit. They just it will even go down below 7,000 and enter loss. So how do you avoid this? You take profit gradually, and this is the formula that I use, that I think is good. If you would be able to take that, if you can learn that, it's good. So TP1, which you know that is most likely, if your analysis is right, is most likely to hit TP1. So TP1, you take, let's say what you bought is $10,000 worth of Bitcoin. Okay, so when it gets to 7,200, what do? You take profit, like you close 50% of the trade. 50% of the trade of $10,000 is $5,000. So you take profit for $5,000 here. TP2, what do you have now? You still have $5,000 left that is still running in that trade. So when it hits TP2, what do? You take 20%. 20% of $5,000. Let me check it out here. I think okay, I can use this one. 20% of $5,000. 5,000 is $1,000. Okay, so TP2, you're taking profit for $1,000. Okay, TP3, you say 20%, and that's $4,000 remaining, right? It's $4,000 remaining. So we change this to $4,000. Taking profit for $800. $800 here. TP4, you're taking profit for the remaining $3,200. Okay, so why is this good? Remember, all these ones you've taken, okay, there's another thing you need to know. When this market moves from 7,000 and you got to 7,200 and you've taken profit, what do? You close that stop loss you put previously, which might be, let's say, 6,200. You close it and now put your stop loss at 7,200 or 7,190 or 7,180. Why? Because if you put it at 7,200, it's possible that, because this is more like a resistance point, so when he hits this resistance point and he breaks it, it can start going to 7,300, and maybe before it gets to 7,300, it will bounce back and come and hit 7,200. So you wouldn't want it to go and hit your stop loss and now keep going up. So you place it a little bit, below that resistance point. Okay, that's if you place that, let's say 7,150 or 180, you're saying that if it hits it, it means that it has broken this resistance that is supposed to be a support again. So if it breaks it, you know that it's going to go and look for another support. When we teach you support and resistance, you understand what I'm talking about. But the good thing is that if you put your stop loss here at this 7,200 or 7,150 or 7,180, it means that peradventure this market does not want to go up again. It wants to go back to 7K or 6,800. It will just close for you at that 7,200 and everything will just close. So you take profit for the move between 7,000 to 7,200, and that is okay. Okay, you're not losing anything. Same thing when it hits TP2. When it hits TP2, move your stop loss also to a little bit below TP2. Same thing with TP3, same thing with TP4. Some people might want to put their stop loss just a little bit below TP1 and just allow it to flow to TP4. If it does not get to TP4, then they are comfortable with taking all the profits on that TP1. So this is a very good strategy that you can use, and you'll be sure that no how, even if the market want to reverse, you will always be in profit. So let's continue. Okay. Under TP4, you can decide to take 10% profit for people that will allow you to get to TP4. So you could even make this 5% and save a moon bag. By moon bag means that you just keep 5% of that trade and leave it in that coin in case if it keeps going up. It's just more like your bag for that particular coin for people who want to have a long-term holding of that coin. Okay, so you won't just be so attached to a particular coin that you wouldn't take profit. No, take profit and maybe leave like 5% of that trade in it in case if you want to keep going up. That's your money. If you want to get to like 10,000% in a year, then you still have 5% in that trade, and it's going to give you that percentage while you use the other capital to trade other coins. So that is it. Now, conclusion: don't rely on others for signals. Make your own signals, but follow these rules. Okay, and even if you would take someone else's signal, please follow this rule. Do not allow just follow somebody sheepishly. You can decide to say, okay, you are busy, you're a government worker, or you're just a newbie and you still want to start making money immediately. Copy trading is perfect for people like you, but if you copy blindly, you have problem. So as we are teaching you and you copy from us or you copy from someone else, have a trading strategy. Work based on these 4 things that I've talked about. You must have your stop loss in place. You must have calculate your position sizing. Okay, you must calculate your risk to reward ratio. Okay, and you must make sure that the probability of winning that trade is high. Once you have these things in place, you can decide to add other strategies to it, and then I tell you the truth, you will be safe. You will be safe. So have a trading strategy, even if you are taking signal from someone else. For young traders and those who are too busy, we will offer this service in our advanced class. Okay, like we said, that when we get to advanced class, everybody must make money, and the easiest way for you to make money is we show you how we are able to come up with our analysis. We give you that same signal, you practicalize it with us. We show you using our Bollinger Band, using all the tools that we use for our technical analysis, all the tools we use for our fundamental analysis. We now arrive at a signal like a trade setup. Now when we will take that trade setup together, and we hope that it will be fast enough within the webinar periods to make you profit. So everyone who attends the advanced class must make profit. That is for young traders. But remember, Mr. Joe and the Texo Academy Group, we are interested in making you to stand alone. It is not just about you taking our signals or signal from any other person. You have to create those signals yourself according to what you learn from us. That is where we'll get to, and that's why we took time to break down these courses into beginners class, intermediate class, advanced class. Beginners class, with most people who are not serious did not enter. I tell you the truth, it was like out of the 116 person. Remember, each group we create, we just need 100 persons to train. So we allowed it to go to like 116, and out of that number, the people that signed up for intermediate class was just 70. So if it is 100, it's 70%. So the other 30% will be weeded out just because of that little tax that we put. So we cannot keep spoon feeding people. We need people who are truly ready to learn and to practice, not people who will learn and they'll just throw it out. I am not here to waste my time. I have a whole lot of things to do. I have a train running as I am doing this training, but I also have a mandate to train people, to train others, to share what I have with others, so that, because I believe God created this universe, to be in abundance. He didn't create it, to have this lack mentality that we all have. We all can be in the market and still make money once our setup is right. Yes, because you that is taking profit on a coin going up, there's a lot of money will still be there waiting, because there are people who are seeing that your take profit at a very small profit. They are looking towards the long term. We have long-term traders, we have mid-term traders, we have short-term traders. So the small play that the short-term traders are playing in the market does not affect someone who has a long-term mentality, does not affect someone who has a mid-term mentality. And their signals will also work if they know what they are doing, because the short-term trader is looking at the short-term time frame, the mid-term trader is looking at mid-term time frame, the long-term trader is looking at the long-term time frame, and all these time frame, they play out. We could, in a shorter time frame, we can be bullish, but on the mid-term time frame we are bearish. On the long-term time frame we are bullish. So you can be bullish in short term, you can be bearish in short term and bullish in long term. So bearish in short term means that there will be a small downward movement within a day, within 24 hours, within 2 days, within 3 days. But within a week, that movement will reverse and give somebody who is trading on a weekly time frame profit. So everybody will make money. There's no need hiding these ideas, and that's why we are teaching it. But we are making sure that anybody who attend our class is somebody, there are people who are really ready to learn this skill and to practice it. So like I said, just 70% got to intermediate. Everybody will not get to advanced. We'll still put up some other criteria for entering the advanced class, and people who make it to advanced class will also take the final classes, which will be live. Like, we trade together, we do our analysis together, everything together. And the promise is that anybody who makes it to advanced class must make money in advanced class. So that is it. I'll be ending here for now. I don't want this video to be too long. So to your success, I still remain your one and only Mr. Joe. Cheers.